Everybody, welcome into today's live stream. Super excited to talk about the market and dive into some ETFs. Special guest Ethan joining us from the team over at the New York Stock Exchange. Ethan, welcome to the live stream.
Yeah, thanks for having me, Gav. Obviously, super excited to be here and talk some markets.
100%. Evan, how are you doing on this fine day?
I am doing well. The title change that I tried to do didn't work, so it's okay.
Tough scene, tough scene. What did it title it for you?
What yours was? Subpar title. We can move on though. I'm excited for this chat. Ethan, how are you doing? Yeah.
All right, let's jump right into
I
things.
want to over here though. I want to talk about what's newest in the ETF space. We talk about ETFs. We talk about the market all day, so that's what I was kind of excited to chat here. I even want to kind of just share my screen. ETF Central is a website we've been using and going a lot of. And Ethan, I was just kind of curious on, throughout this space, this live stream, I wanted to talk just the general themes, some of the newest ETFs that were coming out there. I did see actually one thing that I did want to go towards. If I look at a tweet that I put out, it was on the inflows for Q2, and it was the ETFs that are the fund managers that brought in the most inflows during Q2, which I also thought was interesting, kind of showing where some of the stuff with. And Gav, I don't know if you ended up seeing this one. Let me here. There we go.
The one that had Neo.
Yeah. So we had Vanguard and iShares and JP Morgan and a couple of the big dogs coming in here, but a couple of the ones that we're friends with, the Neos and the Yield Max and a lot of other ones in here making it into it. So I know I just said a couple of things there, but I would love to kind of bring you into it. We brought an expert on the ETF space, and I would just love to hear your thoughts of kind of the latest in that direction.
Yeah, I mean, obviously, I think talking specifically to what we're showing here, obviously you have a lot of the big names that you've come to expect in the ETF industry are going to be at the top. VU's now the largest ETF in the industry, so no surprise to see Vanguard there. I think VU's over 700 billion, so it's the first ETF to reach that benchmark.
I thought there was this today also. These crypto ETFs are starting to pick up. Obviously, IBIT has been flying, but finally this Ethereum one picking up a little bit. So I wonder if that's obviously we are now in Q3. I wonder if that's going to end up being one of the big themes.
Yeah, I think we're continuing to see, tons of movement in the crypto space. I mean, there's the regulatory piece that there's a chance the SEC is going to be looking to give us kind of some more guidance on listing more ETFs in a much more streamlined fashion than the way it works today, which is, has the crypto industry cautiously optimistic on the outlook that could bring to bringing those ETFs to more a wider investment base. But I think, highlighting some of what we've seen recently, innovation in the space, obviously, like you touched on, IBIT's been absolutely crushing it. One of the top inflows when you look at the first half of the year. iShares, they've just been killing it with IBIT. But then also XXRP is really interesting to me. So that was launched by Tucrium, who typically or historically has done a lot in the commodities space. So you talk about corn products, different things in the commodity space, and they are getting into crypto with XXRP.
What was the XXRP you said?
Yeah, XXRP. It's a 2x levered XRP futures ETF. So we don't have spot on XRP yet, like we do some other crypto tokens. But looking at that, they brought in over 400 million. I think they're almost up to 500 million, and that launched 3 months ago. So really looking forward to obviously what's still to come in the crypto space. I think there's a lot of innovation that can happen there still. And obviously, it's kind of a race to be the first to come to market with those because all those products have done tremendously well over the last 6 to 12 months since we talk about, I guess, 18 months when you talk about the first Bitcoin spot products being launched in January, February of last year.
A lot of flow has been coming in. What do you think's changed this year? What's the biggest change that you've seen in the ETF ecosystem versus prior years?
Yeah, I think the biggest change, so not necessarily this year specifically, but something we've seen over the last couple of years is the move to active management. Historically, ETFs have been, index products. You're talking about your VUs, your SPYs, your IVVs, your VTIs. But we've seen a move towards that active management where, the asset manager, the issuer is making, decisions that are impacting the portfolio on a daily basis. Year to date, we're at, I think in the first half of the year, we launched 481 ETFs in the United States, which is on pace for a record year. Last year was the record with 753. we'll probably end up launching more than 1,000 this year, which is just insane to think about when you look back a few years. But of those 481 that came to market in first half, 84%, over 400 of them were actively managed. So obviously we're still seeing, index products come out, but a big shift over the last couple years towards actively managed ETFs. 84% this year. You look at last year, I think it was 72%. The year before, it was somewhere around 65. So we're continuing to see that shift, and I don't think that's going to change anytime soon. I think that's just going to become a bigger part of the ecosystem.
Wow, 1,000 ETFs this year. That's crazy.
Yeah, it's insane to think about. I was doing some research and looking back at kind of the last 10 years recently. And if you go back to 2014, 2015, and you look at the number of mutual funds, there's over 22,000 in 2015. The way it sits today, I think there's about 7,000. So you've obviously seen the decline of mutual funds and the shift towards ETFs. As 2015, you're looking at about 1,000 ETFs, maybe 1,500. And that's what we're going to do in 1 year this year in 2025. So continued shift towards ETFs is big. And that's, for all the reasons I'm sure you guys are familiar with, which I'm happy to dive into if we want to, but I don't think it's slowing down.
Do you see any kind of, not race to the bottom, but like, are people, because of there's so many, are people getting more competitive on the expense ratios? Are they getting, trying to be like first with certain areas? How do you see them adapting to it?
I feel
Yeah,
like I
so
haven't.
go ahead,
I,
Evan,
I,
if you have
want to
thoughts on
hear. I
that.
want to see what I've seen, and then I want to do
Yeah.
what you think. I have not seen changes in the expense ratios. The Bitcoin ETFs did come in and did have a kind of race to the bottom there. Maybe the Ethereum ETFs thought they were going to do that. I haven't seen it that much. 0.75 still feels about natural for some of these active ones. The 2x leverage 1.25 feels like that's where they're at. I couldn't tell you on these income ones necessarily. I have not seen a big change on the expense fees. Ethan, have
Yeah,
you?
no, I think you're totally right, Evan. I mean, I think it's a different conversation when you're talking about active versus passive. Like you look at some of the largest passive, the indexed products, and you are talking about that race to zero that existed in ETFs for, SPY's listed in 1993. You're talking about 20, 30 years before we really see the rise of active. And it's certainly there, a race to zero, lowest expense, because if you have 3 or 4 ETFs that are tracking the same index, it's really tough to sell a more expensive product when the advisor's pushback is, I have a fiduciary responsibility to my client. If this tracks the same index as this other ETF, why would I buy the more expensive one? I'm not doing my fiduciary duty. That changes with active management. So I think, Evan, you're spot on when you say you're talking about the area of 75 basis points, which, isn't unreasonable for an actively managed product when you compare it to an index product. Obviously, it looks high. But what you're seeing is a lot of issuers kind of settle in that spot because what they're trying to do is essentially they found the sweet spot where they can generate revenue off these ETFs, but their salespeople going out and trying to sell these to advisors or sell these to retail clients, they're not having the conversation of expenses, right? If you have an actively managed product at 150 basis points, the pushback you get is, yeah, but it's really expensive. You might be a great active manager. You might be way outperforming, the market, but I can't justify putting my client in something at 150 basis points. So if you're in that sweet spot of 60 to 80 basis points, I think you eliminate that piece of the conversation, and now you're selling your ETF on the merits of your actively managed style, the returns you're generating, as opposed to making it a conversation about cost.
Yeah, I agree with you guys. I kind of wanted to pick your brain on it, but I also have not seen exactly a race to the bottom. In fact, I have found people coming up with ETF strategies that they can charge more for. Talk to me about this rise of income and yield generation and leverage where we kind of went the other way and all the expense ratios are over 1%.
Yeah, so I think first of all, I'll start by saying I think all the income buffer products, obviously they're different in what their end objective goal is, but I think, they've been a tremendous innovation in the industry, taking what you could do as a retail investor at home, right? I'll use SPY from Neos, for example. Right, I could go buy the S&P 500 and then I could write the options. It's really labor intensive, especially if you're someone who's working a full-time job and you're not day trading, for hours a day. It's really labor intensive, and now I can package that really nicely in an ETF that's doing it all the work for me. So I think, obviously, like you mentioned, the expense ratios on those can be higher than what we're seeing. People are charging more for that. And the products that are charging more, it's because they're more complex. They require a lot more trading on the back end that's expensive to do. And they're trying to kind of, capture some of that in those expense ratios. But overall, I think that's a space where you're going to continue to see lots of innovation. You continue to see it. Obviously, you have some big players in that space. You have an innovator. You have smaller players like a Calamos that's launching a lot of those products, and they've done tremendously well since they entered that space. They're launching some innovative stuff as well. So I think you're going to continue to see innovation in that space, and that's a lot of what's coming to market today is in that space because they're really good products for investors, and the demand is there, so they're going to keep pumping them out.
Yes, they definitely have been pumping them out. How do you? Sorry.
I was going to say, I have a question for you guys. When you look at the ETF space as people who, obviously understand ETFs, but aren't in this space all day, every day, like someone like me is, what do you see? Like, what would you like to see come to the ETF wrapper, or things that you see in other places and markets where you're like, that's an opportunity to package that in an ETF and offer it to investors?
Evan, do you want to go first or you want me to?
You go for it.
Okay, so one of the interesting phenomenons that I see here, Ethan, is okay. I think people have to find a middle ground because as a creator of ETFs, your mindset is, hey, I need to make something that the average retail investor, just like you said, right, they feel is labor intensive. They feel is something that they would not want to do on a daily basis. And that's why they will come and buy my product because I'm going to do it for them. But you run into an issue where if you get too complex that they can't understand what you're doing, then people also don't want to buy it, right? It's like that perfect middle ground of this is more work than I want to do, but I understand what they're doing. And that's when people are like, okay, I'm willing to pay for this. And I think that that area is, the perfect area with income products. And that's why they're soaring, is because people can comprehend, hey, selling covered calls, but they don't want to do it themselves. But if you get into like some really complicated areas with these ETFs, especially, I'm sure that you've seen the run of the mill of like all the more complicated strategies. It can be
I
really,
have not seen the more complicated the strategy, the less chance it's going to work.
exactly. That's what I'm saying. It's like
ETFs are this is a marketing game. It's not the best performing ETFs that are going to be the most popular. It's going to be the ones that are telling you the best story and that make the most sense.
Yeah, I think you hit the nail on the head there, Gav. When we're talking to issuers, obviously there's a lot of really smart people in the industry that can come up with these really complex strategies that probably do generate returns, but like what you need to slim it down to at the end of the day is, can you explain this in 4 or 5 sentences to someone with a high school education, right? Like, does that make sense to the average investor in 4 or 5 sentences? If you can't do that, you need to simplify it to a place that you can. Go
right.
ahead.
Well, the harder part is even with the returns is that you cannot show back testing per compliance, right? Like
Yep.
most of my clients will tell me like, hey, like you cannot even talk about what ours would look like back tested. So when you're coming out, it doesn't matter how well it would have done necessarily, right? It's just about them understanding it because you can't even show them track record.
Yeah. And that's another thing we can hit on when you're talking about not being able to show back testing. One thing that's unique about the ETF structure is, I don't know how familiar you guys are with 351 conversions, but moving either a mutual fund or an SMA, separately managed account, you can convert them to an ETF and you bring that track record with you. So where you can't reference back testing, what you can do is instead convert a strategy from an SMA, and now you can show the track record, performance history, and things like that.
Yeah, let me screen share for a second, actually. I'm going to show a few of my favorite ETFs and kind of explain why I believe that these have good appeal to retail, whether or not they have tons of AUM or not. That's why I think they're constructed well. And full disclosure, yes, I do work with most of these fund managers for everyone watching, so I'm slightly biased, but you can make your own decisions and do your research. First one that I'll look at here just to go over is BTGD. It's the stacked Bitcoin and gold ETF. And to me, this one's great. First off, the performance has been, amazing for anyone that's been, looking at this since we talked about it. It's just absolutely run. It's crossed over 100% up since it launched just towards the end of last year. And then, last 3 months, not being an AI product, not being anything of that, it is still up, over 25% and just had a great run. And to me, it's very straightforward. Hey guys, you can put $1 into Bitcoin or you can put $1 into gold. If you put $1 into this, you get equal exposure of $1 to each one of them. We just stack them on top and give you that leverage, and you know exactly what you're getting. It's inside the name, and we're just doing the work for you of creating leverage so that you don't have to go out and play around with leverage or options or anything like that. And it's just boom, it makes a lot of sense to me, right? Here's the ETF, here's the idea, and you can see, you know, it's moving, right? Another 3 million in flows in the last 5 days. It's about to crack, I think it's all-time highs for its AUM right here. As you could see, you know, the flows continuing to move up. So there's a lot of intrigue in this. And for me, like, it's something that I talk to a lot of friends because it's a thing where they can say, hey, I'm very bullish on, well, for me, the thesis is the United States keeps printing money. And so I say, cool, keep printing money. I'm bullish on Bitcoin, I'm bullish on gold. Here's one place that I can get access to both of them. And so for me, this is just like a straight up product that I really enjoy, and you know, have no problem talking to other people about when it comes to these things. And then the one other one that I'll mention is one of the income products, OMAH, which we do a lot of conversations with Adam Patty, and this one's just been going berserk. You can see 66 million just this week that's come into it. And the reason I think this one really stands out is people are like, okay, I get the income thing, but part of the reason I want income is I want stability, and they're running it on Berkshire Hathaway. People put 2 and 2 together, right? Warren Buffett and income, and they mash the two. And so when you can kind of take what I found is this 2 ideas prospect, right? Bitcoin and gold, Warren Buffett and income, right? And you take them and you put them together into one, that can make for a really successful ETF. And it's kind of like the origin of, like, you know, maybe even like on a wider case, like SP 500, right? We're just giving you all the publicly traded, like easy to understand concept, stability, United States, putting them together, right? So like, just to me, like these kind of products make sense.
Yeah, Evan, do you have anything to add on there?
No, I definitely find those ones interesting. I think that the story is important. I think there's themes. We've gotten into an interesting area where we're kind of attaching towards single stocks and then figuring out a ways to kind of do different stuff around it, leveraged.
Well, like,
We also have the yield off of it. We also now we're kind of getting a little bit of like we're aiming for 10%, and then we're trying to get some upside in it. So I find that to be very intriguing. I wonder
Evan,
what's next.
this is me when someone shows me their complicated ETF strategy. Very topical.
Listen, it's just true. We've seen some stuff that yeah, you know, I just think that the simpler it is, the better. But that also doesn't mean that people are stupid. One thing I will say, I think that the retail investor has gotten smarter and smarter. Where someone like a Yield Max and a Neos, it's not like selling covered calls is gonna come in and be like you're in like graduate level stuff. But I also definitely would say that's probably higher than high school and stuff like that. I don't know what spectrum we're going on. So I think that the retail shareholder has definitely advanced and is smarter and can understand some more of these strategies. So it's kind of meeting each other in the middle somewhere a little bit. And like Gav was saying, some of the best performing ones are like those ones that are kind of touching the edge of it somewhere a little bit, where maybe they're more complicated than you would think would have worked in the past, but for some reason it is.
Yeah.
I
Yeah,
think
there's a huge race now on the double leverage one as well, because now that you have like 3 or 4 of them, right? It's the same thing. And so now everyone's just racing to say, all right, can we be the first one to get it out for that stock? And people are just getting creative. And then it's like timing it up with like, okay, can we be the first one to get it out for that stock, but also while retail is hyping up that stock, right? So like, can we get this out now? And so it's impossible most of the time because it takes 3 to 6 months lead time sometimes to get these things up. And so you're playing a game of strategy and luck.
Yeah, I think, Evan, you hit something that I was also going to say after what Gav said, which is your average retail investor is definitely a lot smarter than they were when you go back 5 to 6 years, right? You talk about COVID, people stuck at home, people start taking their investing into their own hands. That's where a lot of, obviously retail exists before then, but that's where we see a surge of it. And from an exchange perspective, we kind of expected this volume is going to be, a 1-2 year thing, and it hasn't subsided. Those retail investors are still there. They found something they're passionate about, and then they're, trying to find those products that fit, what they're looking for. And you're certainly seeing that race, Gav, that you're talking about when you're talking about, levered single stock products, who's can be the first to market. When you talk about something like a MicroStrategies, you go back like 9 months. I don't know that anyone knows who MicroStrategy is. I guess they go by strategy now. But now you have levered products all over the place on MicroStrategy. It's that race to, hey, this is hot right now. How can we be the first to market? How can we get there as quick as possible? Obviously, the biggest impediment to that's filings with the SEC and all that fun stuff, the legal work. But yeah, it's that race certainly exists today.
Yeah, a lot of good points. I wanted to flip it back at you. If you could talk to me a little bit more, what's like the day-to-day look like working with these different ETFs? How do you assist them?
Yeah, so it's a combination of a few things where I sit. So managing client relationships. So part of that is you want to list an ETF. You have to pick an exchange to list it on. Obviously, we want you to list it on the New York Stock Exchange. Proud to say that we're home of about 2/3 of ETFs in the industry and 75% of assets, which crossed 11 trillion in the first half of the year, which is crazy to think about. So obviously there's an element of, how can we support an issuer and make them on a list on the New York Stock Exchange, and what benefits can we provide? Obviously it's one of the most iconic brands in finance, so we're leveraging that. But then it's also working to help grow their business, and that's the bigger piece of my job. Is I don't think it's any surprise that the exchange generates revenue when shares trade on the exchange.
Right.
So we need products to grow. If something launches and has $2 million in it and never trades, it trades 50 shares a day, it's kind of a dead product. Doesn't mean that we don't want those products, because there's still the potential to help grow those products, which we're working very hard to do. But as a product grows, as an issuer grows, we're growing alongside them. Our success is tied to theirs in the sense that they get more assets, they trade more, they generate more revenue, and we generate more revenue. So it's working with those issuers to help grow their businesses from day one when they launch.
Are you allowed to own ETFs?
I'm allowed to own ETFs. I'm not allowed to own single stocks.
Oh,
That
interesting.
normally means, though, that you're not allowed to own ETFs with, like, it has to have X amount of stocks in it. Is that correct?
They have to be diversified. Yeah.
Is it 100? That's what it was for my friend who worked at a bank. I was like, oh, that sucks.
I don't know what the exact number is. All I know is that I can't buy 2x Tesla or 2x MicroStrategies.
One product that I'm kind of a fan of, and I'm surprised this whole suite hasn't gotten copied a little bit more, is this QTOP ETF. It is iShares NASDAQ. I swear to God, I literally said this idea on our spaces like a week or two before it came out. Just consolidating around the top. I would do the strategy a little bit different. It's got $130 million AUM, nothing crazy, but
13%
decent
NVIDIA,
launch.
baby.
Yeah. So what this is? Where did you see the holdings? There we go. What this is more concentrated at the top. This is the top 30 NASDAQ 100 stocks. I believe they still market cap weight it. I would probably do some sort of I would change it up. I don't know if Lindy actually belongs there, but
I was looking at it on Robinhood. There were slightly different percentages.
yeah, this is data as of May 29th, so this is actually a little old. I bet you can't buy this. 30 stocks.
30. I don't know. Maybe I should try.
QTOP. I'm a fan, and I do not work with them.
Tells me. Yeah, I think there's a lot of great products out there, and I'll say I own the Qs. Now that's more than 30. I think there's also an opportunity, especially within the tech space, when you talk about innovation that could be happening with different indices there. I think there's, potential in the tech space. I mean, there's indices, like you look at the Qs that are built 30 years ago. Maybe it's not quite 30, but probably 20. About 20 years ago, and haven't been changed a whole lot. So I think there's a lot of new products that could be coming out in that space that look to challenge that. Obviously, you have the
incumbent. What I think it is? We are waiting for a new Dow Jones. I think that QTOP or Top T, those ones, I think are it with the wrong marketing.
I don't think you're necessarily wrong. I mean, when you look at markets today, right? When you look at when the Dow was created, right? The market was driven by industrials. Today, the market's driven largely by tech, specifically, when you talk about the Mag 7 and different things like that. So I don't think you're entirely off base to say that that can become the measurement by which, the markets are viewing success.
So you mentioned that you like SPY. I'm just curious, I don't know how much you can talk to it. Any ETFs outside of SPY and QQQ that you're fans of, and why?
So I'm a big user of Vanguard funds, just because of low cost. They're a good client of mine, obviously, as well. So I won't get too into the weeds, but I don't own a whole lot of the super complex products, because you get into issues with reinvesting dividends, stuff like that, having access to MNPI. There's compliance concerns there, so we have to own pretty vanilla stuff, unfortunately, when it comes to ETFs and
Boring can be good in
stocks.
the market.
That's what I mean.
A lot of
Honestly,
VUG.
if a fair amount of VUG,
Yeah, I
I'll
got some
say,
of that
like,
too.
unless obviously, right, there's a lot of investors that are very tuned in to what's happening in markets, and there's a fair amount of them that also aren't, right? They're putting money away for retirement. They're kind of set it and forget it. I'm not going to look at it for 40 years and it'll be there when I need it, kind of thing. And for those people, a simpler approach is better. But for the person who's really into markets and understanding what's going on, a lot of these, complex products, maybe that's a levered product, maybe that's an income product, right, where they're understanding the mechanics of what's happening and how to generate higher returns over those 40 years. I think that can be really beneficial for the end investor.
Got it. Yeah, listen, maybe they're helping you out in the long run. Stick to those boring ones. They can stack up. Uh, Curious, right now, how much like data do you get to see on, retail involvement, institutional involvement, all these different pieces when it comes to people investing in ETFs and these flows?
So where I sit, we don't see a whole lot of it. So where a lot of that data is going to live is on the different platforms. So you talk about a Fidelity or a Schwab or a Merrill or a JP Morgan or a Robinhood. That's where they're going to have access to understanding a lot of those flows. Obviously, I can see how many shares are trading and who's trading those, broadly speaking, at a very high level. Like, we can't nail down if someone were to say, hey, who did this trade in SPY at this time on this day. I can't see anything like that, so I can't necessarily point to this amount retail, this amount institutional, but I can say that a growing portion of what we're seeing on the trading side is retail. Obviously, you have large institutions that have trillions of dollars when you talk about the likes of BlackRock and Vanguard and State Street, but a bigger portion of those trades and what we're seeing is becoming retail as people become more invested in their future, but then also knowledgeable about what they're investing in.
Love it. A couple things I want to hit on here. I was looking at ETF Central. Always interesting to see state of the market right here. So 7.9 billion coming into large cap, but money leaving mid cap, money leaving small cap, and closer to flat on the global blended area. So that's pretty interesting. So this seems like a bit of rotation out of risk, if you ask me, sorry, go for it.
Yeah, I was going to say exactly that. So I think when you look especially at the first half of the year, you have things like Liberation Day, April 3rd, I believe, if I'm not mistaken. I think since then we've seen a significant shift towards risk off, right? Moving into large cap stuff that's a little quote unquote safer than small and mid caps. Fixed income in the first half of the year in ETFs set its high water mark. So the highest fixed income flows we've seen in history. They brought in about 40% of overall ETF flows in the first half of the year, which is a number that we haven't been, I don't think, really even close to in the past. Trying to see, I have the exact number here somewhere. If I find it, I'll shout it out. But I think you're not wrong picking up on that trend. We're seeing people move into those safer investments as there's kind of uncertainty, right? There's a lot of uncertainty around tariffs and where the dollar stands and what that's going to look like 6 months or a year from now. And people are certainly moving into not wanting to step away from the market altogether, but step into things that have been perceived as safer investments.
Yeah, super cool for anyone that wants to just, ideate and find ETFs. It's nice that you can just see the corresponding ETFs underneath each one of the segments to see how people could take a look at those areas. Also, this was pretty neat. Is this the first dual listing?
So for ETFs, yes. So today, actually, it was this morning, Strive dual listed all 13 ETFs that they have today that trade on the NYSE. So exciting day for us. The first ETFs we have on NYSE Texas. So obviously making a push there. There's been a shift. I think we have around 30 or 40 corporate securities. So just general stocks that are also listed on NYSE Texas, but these are the first ETFs. So seeing a shift, obviously, I'm sure everyone's seen what happened with Elon Musk and Tesla and Delaware and that court system. So they reincorporate in Texas, and Texas is actually the largest state for the New York Stock Exchange in terms of corporate listings and corporate issuance. So we have, big investment in Texas. A lot of that's obviously energy and oil. So really making a push to be the market leader there. I think there's a lot of opportunity there, and there's a whole lot of Texas pride out there. So looking to bring investments that hit close to home for people that want to invest in companies in the energy space, in the oil space, and then specifically when you talk about Strive's ETFs, having another platform for those ETFs to trade on, right? You talk about things like more liquidity, another trading venue. So we think those things can all be benefits to end investors.
Very cool. Very cool. Yeah, nice to see the expansion. Nice little trending section here too, just to see what people are comparing across the board. But fun little look there into ETF Central. Evan, what else is on your mind?
I don't know. My next question was going to be when we were talking the Vanguard ETFs was how much VTI is in there. Sometimes I think people go a little too heavy in the VTI than some of the other ones, but I don't know if we need to necessarily keep digging into the portfolio. You didn't know it. You signed up for a portfolio analysis stream. I get the portfolio up there.
VTI is certainly in there. Probably lower weight than you think it is. So when you say that sometimes it takes up a little too much of a portfolio, I don't think I'd have that problem.
Got it. Cool. A lot of good stuff. I'm pretty happy with what we ran through for the most part here. I want to just pull back the general markets for a second. We talked about some of the rotation and some of those pieces. As somebody who sits there and is very involved in these pieces and probably talks to a lot of people who have a lot of an understanding of them, what's your take right now on just pulling out to the macro situation, the things that people who are investors who are watching the stream right now, which by the way, thank you to the 6,000 of y'all who have tuned in. Feel free to reshare the stream wherever you're watching it. What would be kind of your message to them to look out for as we move through the latter portion of the year to be aware for their investing?
Yeah, I think, with uncertainty comes two sides of the coin, right? There's the side of risk and there's the side of, potential, a lot of potential profit that's going to be out there. I think, the biggest thing is being in tune to what's going on, what's happening out there, especially if you're someone that's in some of those investments that are maybe have a little more risk, but more upside, right? Being in tune with, whether that's policy or different trends that we're seeing, how those can impact those investments, I think is a big thing. And, picking and choosing your times. I know there's the famous quote out there, you buy when there's blood on the streets. And obviously we're not seeing tons of blood on the streets right now. Markets have performed pretty well since a lot of the tariff uncertainty. But I think there's a lot of opportunity out there just due to uncertainty. So even if it might not be blood on the streets, I think there's a lot of uncertainty out there. And I don't think that's just among the general, retail investor. I think that's across the board. I think that, obviously there's a lot of firms out there that are really smart, but I think anyone would be lying to you if they looked you in the eye and said, I have it figured out what's going to happen the next 6 months till the end of the year. I think there's a lot of uncertainty, and with that comes a lot of opportunity. But you also obviously have to be mindful about the risk that you're taking, because that comes with a lot of downside too.
It's funny you should say that. I actually do have it figured out, and everybody buy my course. It'll tell you right in. No, I'm just kidding. Uncertainty, I agree with you. It breeds opportunity. So that is a good point as well. If everybody knew what was going to happen, probably wouldn't happen. It's like when we think, hey, we're going into this day. It's so obvious how the market's going to react. This earnings or tariff day or whatever it is, right? And it's always having those two sides, and that's what makes a market.
Yeah, certainly. And I think there's also something to be said on, being a retail investor and right, not having the access to a lot of, not necessarily information that institutions have access to, but understanding that they have a team of hundreds, if not thousands of people. And a lot of these things get priced in before the average person can capitalize on them. It doesn't mean it's totally gone, the opportunity there, but I think it's important to be mindful of when you're thinking about, there's a lot of really sharp people out there that get paid pretty handsomely to be really smart about these things. So follow the signals, they're producing, because if you pay attention to what's going on, you can kind of ride on the coattails a little bit of those really smart people.
Okay, so this is a little bit of a different question then, because it's outside of ETFs and it's more individual single stock. But we have seen a retail mania phenomenon coming back a little bit. You've seen a lot of stocks.
Open the door. Open the door.
Yeah, open door. Yeah, that one obviously has gone pretty crazy. What did it end up doing today on OP?
Probably down.
No,
It's kind of
up 5.5% on the day. Peak of the day was up 27%. Still up 52% on the year. You've got D Nut, Krispy Kreme.
I was gonna say Krispy Kreme's in there. I think GoPro as well.
Flat
They've both been
today
going
on the
kind of
day.
crazy.
G Pro, shout out. I was thinking about buying a GoPro at Costco the other day. Something interesting. Yeah, they shot up about 85% this week. I don't know if you guys were looking at it, but American Eagle did a Sydney Sweeney ad, went up
20%, I think. I don't know where it closed, but it was
at one point.
Was
I
it?
did. I put out a post today. We're getting dangerously close to a Sydney Sweeney Bitcoin treasury company.
I saw that tweet, Evan. I thought that was pretty funny.
Holy Bitcoin!
I thought so too. I was happy with that one after it. I chuckled. Also, what made me laugh today? This Jerome Powell Donald Trump thing. Hilarious.
It's only a matter of time before we all get rug pulled by a Sydney Sweeney crypto token.
Yeah, that Jerome Powell Donald Trump thing was so funny. Did you watch the video, Ethan?
I didn't see that video. No.
Oh my God! Can we do a little live?
Yeah, let's do it.
Yeah, let's do it.
All right.
Let me get it up.
Did you post the video, Evan, or no?
I posted one of them, but there's like a full clip. We could just watch it.
Okay, I have the full clip right here. I'm just gonna give me a second. Let's go ahead and share. For anybody who's watching, if you haven't seen this yet, it's a beauty. All right. Can you hear?
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
Beautiful screen.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out.
Our notes had it about 3.1 as well.
3.1.
3.2.
This came from us?
Yes. I don't know who does that.
Are you including the Martin renovation? You just added
our entire capital.
Yeah, you just added in a third building is what that is. That's a third building.
Well,
including
no,
the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's
So,
not new.
So we're going to think.
Kyle, you said you had the full clip. Literally, only had a tiny piece of it. This guy thinks he watched the whole thing. Huh.
I thought that was the whole thing, and then they take their hats off.
There
How much
was
better does it get?
the whole interview. No, that might have been the peak of it, but the whole interview was
Okay,
hilarious.
that's the peak of it.
He comes up. No, you just watch the full thing.
All
But
right,
it was.
I'll figure it out. I'll figure it out. I thought it was hilarious what I watched. Yeah, Ethan, you think we're getting some rate cuts soon or no?
No comment. And I don't say that in terms of indicating yes, and I don't want to say anything. Obviously, I don't know. I think the whole situation's interesting. I mean, love or hate Donald Trump, and probably a lot of people in between that. I mean, it's like we haven't seen this before. One that's so actively, pressuring the Fed, but then also a Fed that's pushing back so aggressively. So to be determined on what's to come. I know some things I've seen are pricing in a few rate cuts before the end of the year. Whether or not those actually happen, who knows? I know that we had a similar situation last year. But I think I'm not going to necessarily be the expert on monetary policy and the impact that would have on markets. But it'll be interesting to see what plays out and then the effect and opportunities that come from that.
For sure. Question for you, and this was bringing it back to what I was talking about before with the retail mania. Do you think any of that retail mania could ever translate over to ETFs, or could it not because you don't really have like short interest and other things like that?
So it's a good question. I think it could in some senses, and in other senses it can't. I mean, maybe when you talk about some of the single stock stuff, obviously a lot of the retail mania, quote unquote, meme stock stuff, right, surrounds a company typically that's not doing very well, and people propping it up in some way, shape, or form. Or in some cases, it is legitimate where they believe, hey, if they get a cash infusion, there's a chance that they come soaring back. I mean, you look at like the financial crisis, and people made a lot of money buying banks at a really low point. That's not to say that because the banks weren't in a good position. Some of these other companies, who's to say that they're not in a bad position, they'll come roaring back too. When it comes to ETFs specifically, I think there's a chance when you talk about specifically about single stock stuff, because so much of it's centered around rallying around one company. I don't necessarily know that you'd see, even you talk about QTop, that's 30 tech companies. I don't think you're necessarily going to see people rally around something of that size and magnitude. But I don't think it's necessarily out of the question when you talk about ETFs. And it's not even to say single stocks because people want to rally around a company. There's a lot of ETFs out there that, are really low in assets, and maybe they perform well, maybe they don't. But I mean, you see things like at one point, there was the Jim Cramer ETFs.
Oh yeah, S Jim L Jim.
They launched an S Jim and L Jim. So I mean, even things like that, like those made headlines with retail people, even though they didn't end up doing super well. I think there's the potential. I mean, you see it with something like that, like a glimmer of it. I don't think that as ETFs become more prevalent, there's a reason that that couldn't happen.
One thing that we know hasn't worked, that has tried a couple times, is this social sentiment ETF concept. There's been a couple companies that have tried it. Not, maybe it was 2021 thing. I haven't seen as many recently. It just doesn't work. I wonder if people can really kind of play in that. It's not the exact same thing as you're saying, God, but it's kind of capturing that meme sensation in a bottle and putting it in an ETF form. I feel like some of these single stock leveraged ones, you pick the right one, it goes meme. I mean, maybe that's the closest thing you get to it. But I feel like social sentiment was people trying to get this, and they just kind of missed it.
Yeah, I think that makes sense to me in terms of I think the one big flaw, and I'd have to do more research. I obviously haven't dug into the actual mechanics of the social sentiment ETFs, but I'd be curious to see how delayed those are, because what's popping off on Reddit one day might not be what's popping off a month from now. So if your social sentiment surveys are lagging by 30 days, then you might be missing the boat already. So I'd have to look deeper into those and see kind of what that delay looks like. But that's the first thing that comes to mind when you talk about those is, are you working on a delay, or do you have someone, reading Wall Street Bets and they're saying, oh, this is going to be the next meme stock. Let's put that into the ETF.
The problem that has been is where they have found those ideas is at the top when they're all big and everyone is talking about them. And that's a lot of times it's super loud when the move's already through. Where they need to find a way is when those kind of like small inklings are starting, those kindling is starting to be in there and what it looks like. But yeah, that's what I thought it was. I thought it was more, hey, this thing just moved, will it continue? Versus, hey, this thing is really popular, it's about to move.
I'm also curious.
Yeah, go for it. Sorry.
What do you guys think? So I think the legality of this would be questionable at best, but how many of the meme stocks do you think originate organically versus how many of them have their own people in there trying to get their stock to be the next meme stock?
I don't know if it's their own people, but I'm certain that they work together with like social media people to do so.
Yeah, certainly.
I don't know. I mean, I don't know if they're telling them, hey, pitch us out as a meme stop. They're just saying, hey, we'd like awareness.
Yeah, drive awareness around. Yeah, I think that makes sense around our stock. And yeah, I was just curious, you guys who live kind of, with the retail side of the world that I don't get to touch as much of. Always curious to hear about that.
Just because the thing is like, there's not a huge benefit to companies to being seen as a meme stock, in my opinion, because typically, what goes up is going to come down. And so your only real benefit is like maybe if you're trying to run like a shelf offering, or you're trying to, do like an ATM or something, and you're like, we just need cash,
Yeah, and you're going to try to issue more at the top.
Exactly. Like that's because otherwise it's not sustainable.
Yeah, there's no real benefit to the company other than being in the news. Maybe you see Bed Bath & Beyond, and obviously they end up going bankrupt at the end of the thing. But you see them soar, and they try to issue more stock based off of that. And it's like, I guess that's really the only way for a company to capitalize off of it, because once the shares are already issued and they've collected the money on that initial offering, they're not bringing in more money just because the share price goes up trading on the secondary market.
Yeah. Checks out. I think we hit on a lot of the stuff that I wanted to touch on. Evan, anything else you want to cover in here?
No, I think that's most from me. I will say my first thought with a lot of those ones is, all right, they kind of also have their out now too. Just become a Bitcoin treasury company, buy Bitcoin, dilute your stock, buy Bitcoin, see where you end up.
That whole phenomenon's crazy to me.
I don't get it.
the market will pay $2 for $1 worth of exposure to Bitcoin. And I don't know if you guys read Matt Levine from Bloomberg at all, but he's made some arguments for kind of the actual practical reasons that it could be happening. But just the idea that that phenomenon exists is kind of crazy to me. And I think we're going to be seeing that. Obviously, you have a couple Bitcoin ones out there. I think we're going to be seeing some other tokens as well. If you guys know Tom Lee, think he just
BMNR. Here we go. I've been trading it. I can't lie.
But I think we're going to see some different products that are going to try to capitalize off that model, and we'll see where it goes. Tom Lee's ETF's done really well. That's GRNY is the ticker, I believe.
Yeah, Granny Shots.
Yeah, Granny Shots. So we'll see if he's able to port that over to the MicroStrategy model.
Honestly, Granny Shots doing better than I thought it was. Wow.
I think it's almost to 2 billion now.
Wow.
Am I off base saying that? Yeah, 1.9.
Tom Lee is 2025 is the year of Tom Lee. He has it.
Tom Lee and Dan Ives, with his wild outfits on CNBC. He just launched an ETF.
Ticker Ives.
Ticker Ives. That launched about a month and a half ago, and they're at like 400 million.
Yeah.
So.
Yeah, it's crazy. What do you think of that phenomenon now of these successful fund managers building ETFs? Yeah, obviously, you have to be very careful because, for example, with Dan Ives, there has to be that wall in between, right? It's inspired by his research and other pieces.
Yep.
He's not a direct fund manager.
Yeah. So I think, generally speaking, obviously painting with a really broad brush here, I think it's good for ETFs. Right? People who follow Dan Ives, people who follow Tom Lee and, the thought leadership they're putting out in the space, if that gets them into ETFs, it's good for our industry, plain and simple. Obviously, right, there's a line between where you're selling your persona and the brand you've built, and then, becoming a snake oil salesman. I don't think either of them are doing that. Just to be clear, I think they're both, solid products. And if the returns are there, the returns are there. And if your name and your reputation and, your intelligent, not necessarily intelligence, but the thought leadership you're putting out there and the expertise you are perceived to have helps drive that growth, I don't think it's necessarily a bad thing.
Yeah, I think it's definitely bringing more people into the ETF ecosystem. So I'm a fan of it from that perspective.
Yeah, certainly.
Okay, perfect. Awesome. We'll move to some wrap-up comments. Evan, any final comments from your end?
I am a fan of ETF Central. Great website we were showing off during this. Fan of Ethan as well. Appreciate you being here. Shout out to the New York Stock Exchange as well. So a lot of people, we are, doing cool stuff in the space. I know we talk about the New York Stock Exchange Texas edition, or I know that's not how you would say it, but it's okay. I'm excited to watch that grow. When I was announced like maybe 2 years ago, whenever it was announced, I remember on Twitter that it got a very large interest, a lot of likes on that post, a lot of views on that post, and there's a lot of interest on it. And even since then, people have still been excited about it. So I'd imagine that's something that we're only in the early days of hearing them talk about. I still love New York. I think New York's better than Texas, but it's okay for Texas to have its little cute thing on the side as well. But I appreciate you. I think this is a great stream. Wherever you're watching this, make sure you're going in, following the channel. And I appreciate it. This is good for me.
Perfect. Ethan, any final comments for the audience?
No, I don't think anything in particular, but obviously thanks for having me. This was phenomenal, and you guys have a great audience, and excited to, be able to hopefully shine some light on the ETF world and the work that's going on there, to bring some value to investors, and looking forward to hopefully joining you guys again in the future and continuing to build.
Love it. Thanks so much for coming on. Appreciate the 7,500 that tuned in. Hopefully you enjoyed a good conversation here around ETFs. Go check out ETF Central. Check out everything that the New York Stock Exchange is doing, and we will be back shortly with more live content. Have a good one, everybody. See you on the other side.